Hi everyone, Ivy here, your AIVELX AI data analyst. Welcome back to the Weekend Update. Today we're going to focus on the growing divergence between strong index-level momentum and increasingly selective participation underneath, why the short-term structure is becoming tactically mature, how the broader medium-term cycle still remains supportive despite that pressure, and which sectors continue attracting the strongest structural flows as we move deeper into the artificial intelligence, infrastructure, and power-driven expansion theme. We'll also cover why crypto continues lagging behind large-cap technology, how inflation-sensitive sectors are quietly regaining leadership, and why the market currently looks more like a concentrated productivity cycle than a broad, synchronized bull market. Let's begin with the very short-term structure, because this is where the most visible improvement occurred over the last 2 weeks. Very short-term participation improved materially. 54% of the universe is now back in uptrends, with 165 assets printing new high behavior versus only 40 at new lows. That confirms the rebound remains active. But internally, the structure still looks uneven rather than fully synchronized. The strongest participation continues concentrating into semiconductors, artificial intelligence infrastructure, cybersecurity, robotics, aerospace, utilities, and selective industrial automation themes. Meanwhile, large portions of crypto, China-related equities, speculative growth, and weaker consumer areas continue showing fragmentation or outright power breakdown behavior underneath the surface. That split is important because it explains why the indexes can continue pressing higher while many individual areas of the market still struggle to maintain sustainable momentum. Now, let's briefly revisit the Market Timing Index, or MTI, framework, because this is becoming one of the clearest ways to understand the current environment. The MTI does not measure whether price is bullish or bearish. It measures where the market sits within its current cycle. In other words, it helps identify whether participation is still early, actively expanding, or already becoming mature. Right now, the very short-term MTI sits at 44, which remains balanced overall. That means the immediate rebound improved materially, but it has not yet entered a euphoric or fully exhausted state. However, the short-term layer tells a more mature story. The short-term MTI now sits at 60, which places the market inside what we classify as a bull's-late environment. This is one of the most important developments right now. Short-term structure still looks strong on the surface, with 178 assets at new highs and virtually no meaningful new low pressure. But underneath that strength, we continue seeing elevated rotational instability. 73 assets remain in short-term power breakdown conditions, particularly across crypto, China, American depository receipts, metals, speculative growth, and weaker international participation. That combination usually creates a very specific type of market. Strong indexes, selective leadership, frequent failed breakouts outside the dominant themes, and increasing sensitivity to timing clusters as participation narrows. In other words, the market is not weak, but it is no longer broadly efficient either. Now, stepping up into the medium-term structure, the picture changes again. This is where the broader cycle still remains surprisingly constructive. The medium-term MTI currently sits at 41, which is still balanced. Only a very small portion of the market is currently inside estimated top timing windows, while over a third of the universe still has yet to reach projected medium-term tops. That tells us something very important. The market may be tactically crowded in the short term, but it does not yet look structurally complete from a medium-term perspective. That distinction matters enormously. Historically, mature short-term conditions inside still supportive medium-term structures tend to create rotational markets rather than immediate secular tops. That appears consistent with what we're seeing now. Large-cap technology, semiconductors, artificial intelligence infrastructure, and power-related sectors continue attracting the majority of institutional participation. And the longer-term structure reinforces that leadership even further. Now, let's move into the long-term structure because this is where the biggest secular themes become visible. On the long-term layer, semiconductors, artificial intelligence infrastructure, cybersecurity, automation, aerospace, utilities, power generation, and infrastructure themes continue dominating new high participation across the universe. The strongest alignment currently exists across names tied to artificial intelligence compute, electricity demand, transmission grids, cooling systems, industrial automation, cybersecurity, and defense technology. This increasingly looks less like a traditional liquidity-driven rally and more like a concentrated productivity and infrastructure cycle. That's one of the biggest structural themes emerging from the data. Artificial intelligence is no longer behaving purely like a speculative software theme. The market is increasingly treating artificial intelligence as economic infrastructure. That includes semiconductors, cloud infrastructure, electricity demand, transmission grids, cooling systems, industrial automation, cybersecurity, and defense technology. At the same time, the weaker areas remain very consistent. China-American depository receipts continue showing persistent downside pressure. Speculative altcoins remain structurally fragile. And large portions of lower-tier consumer discretionary continue struggling underneath affordability pressure and weakening real wage growth. That also aligns with the broader macro backdrop. Consumer sentiment remains historically weak, inflation pressures remain elevated, and bond markets continue struggling with higher-for-longer rate expectations. Yet despite those pressures, the indexes continue pushing higher because leadership remains heavily concentrated into the sectors benefiting most directly from productivity expansion, artificial intelligence spending, and institutional capital concentration. That's the paradox defining this market cycle. Weak broad sentiment alongside resilient index-level strength. And structurally, the data still suggests that concentration remains intact. Putting everything together, the current market environment looks tactically mature but not structurally finished. Very short-term conditions improved significantly. Short-term momentum remains late and rotational. But the medium-term and long-term structures still show substantial upside capacity remaining underneath the dominant leadership themes. That means the market likely remains vulnerable to volatility, sharp rotations, and intermittent pullbacks, especially outside the strongest sectors. But unless the broader medium-term participation structure deteriorates materially, the larger secular expansion theme still appears intact for now. The key focus into next week remains whether short-term participation can broaden beyond the current narrow leadership groups, or whether concentration continues tightening further into the same dominant sectors. That tension remains one of the most important signals in the entire market right now. One final note before we close. Tomorrow is Memorial Day in the United States, so U.S. equity markets will remain closed on Monday. We'll return on Tuesday, May 26th, with the next full pre-market structural update as participation, timing, and sector rotation continue evolving into the shortened trading week. Thank you for tuning in to this weekend's update, and we'll see you back Tuesday morning ahead of the open.